we're going to talk a little bit about the economy. And the more things change, the more they stay the same, right? Has it been the same way for quite some time now, where you go to bed and you wake up in the morning and something's changed? Absolutely, right? It's been that way for quite a while now. And I don't think that this year is going to be any different than that. I think we'll probably have more volatility, so we may see more of the ups and downs. I think I was telling some of you earlier, this morning the market was starting on the upside, probably went to the downside, and now we'll back up again. We've had probably about a 600-point swing between the ups and the downs already today in the Dow. So what are we worried about, or what do we think is going to be the positive for the economy this year? We are very positive on the economy this year. We do believe that we're going to see some economic growth. As we're looking here, we're forecasting about a 2.1 to a 2.2% GDP. So what this slide is showing me here is that we don't expect it to happen until the second half. Part of that has got to do with when things start to look. We know more money's going into manufacturing. That takes a lot longer for that to show up into the economy. We also know that the big, beautiful bill, whether you like it or not, it is going to have some effect on tax returns this year. And so again, money will then be going into the economy. So this starts with fourth quarter of 2023 and goes all the way to the fourth quarter of 2026. The blue lines are annualized GDP that's already happened. The orange bars down here are the ones that we're still anticipating. So fourth quarter, we now know it was up a little bit more than 0.8%. We do believe that we're going to see 2.1 to 2% for the rest of the quarter of the year. So we do believe that we're going to have a pretty good year when it comes to GDP. Here's one of the reasons why. Whether you love it or hate it, I know it's a conversation around here. Are you building a AI center or a data center? Okay, I know there's one coming to this area. There's one in Perrysburg that I go by. It is kind of wild to watch it from the time that it first started. The stakes went up, the fence went up. It has been secure on day one for over a year. It looks like people by there late at night. There's lights everywhere. There's people roaming, watching, paying attention to everything that's going on there. Kind of looks like an alien show inside there, not real sure, but there's a lot of workers there too right now. So it is a good thing as far as employment goes. But what we're talking here is intellectual property. So what do we mean by intellectual property? So that's always been a big thing with China, right? They steal the intellectual property. So a company goes to work there, they like the things that they're seeing, and they steal. Where most of the time we don't. That's not something that's approved of. How about that? So if I manufacture something or I make something, it's mine. Okay, and somebody can't copy it if I've copyrighted it or it belongs to me. And so intellectual property now with all the new AI and all the things that are coming out is very important. No one wants to take their technology that they've written and done. So it is really even now what we believe it's going to be 7% of the economy this year because there's so much changing. So consumer spending on goods and services, we spend more money on services than on goods these days. So think about that. So if you're going out, we're paying for it. You know what the biggest growing service is? Not this year, but it has been in the past. Food delivery. We don't even go to the restaurant and sit down anymore. We have somebody bring it to us. So that's one of the services that we're seeing out there. We have the traditional other services that are out there, but for goods and services, 24% or 45% of the actual economy. And then we get down here to business equipment investment. We're seeing that on the rise. So I believe that number is probably a little bit low at 6%. I do believe it'll probably add more to the economy than that, 6%. Then we get into intellectual property, and then we get in all the rest of it that is going on down below that. That's basically what's showing here in this slide is that ISM or services, versus the CPI, which is the index that we watch. They're about the same. We're still seeing that services are a little more expensive than what we're seeing with actual production being seen. So 10-year Treasury. This is always a fun fact for me. When I went to school to learn about economics, the Treasury market, boom, it was just slow, methodical, it was safe, nothing changed. Now with the bond market works just like the stock market, it's a little crazy, okay? It goes up and down, things that would used to take a year to happen in days. So when I got up this morning, The 10-year treasury was at about a 413, 414. By the time that the numbers came out that showed that jobs were a little bit better than we anticipated, and spending was a little bit down from what we anticipated, the bond market didn't like that because it meant we were probably not going to get a rate cut. So that made things change a little bit. This here is showing the 10-year treasury. The 10-year treasury is a thing that's most closely correlated with home loans. This is normally how they factor in what the rate is going to be on a home loan. So if you looked here, we started in 2015, okay? We see there that that rate was somewhere under 4%. All right, if we go all the way up here, back in the first part of 2024, where that rate was closer to 6 to 7%. So now we're back down. It has come down some. When I looked the last I saw, a home mortgage for a 30-year mortgage is somewhere around 5 3/4 or 6% right now. So it's down a little bit from the high. And I think that will help some. Spring and a little bit warmer climate will also help with the housing. But this here is just to show about the 10-year treasury, how it ties to home ownership and that part of the economy, right? Part of the economy that's struggling. What else are we struggling with homes? We don't have it up. That middle part of the market cannot go out and just buy a house. There's not that middle part there. The high end, they're not selling as quickly as they once were, but they're still there. But think about it, when you were and we were first looking for homes, I shouldn't say all of us because we're all different ages here, but still, those here are a little bit more affordable than they are today. The average first-time home is somewhere around $260,000 nationwide. I don't think they're quite as that expensive here, but if you go look and see how many of those are for sale right now, you'll find out. So that's creating some of the housing, which is also why no one's moving and going back and forth. That's part of the economy. And if we're not buying and selling houses, that's another thing that the economy is slowing down just a little bit. So back to our GDP. We want to look at GDP around the here totals, right? Not just what's happening here. So in 2026, our forecast for the United States here is somewhere around 2%. Really a little bit higher than that, about 2.1, 2.2. In 27, we think it's going to be even a little bit more than that because we'll get the tailwinds of what's going on this year with the manufacturing. We look at Europe, there's not a whole lot of growth going on in Europe. It's like Japan, the same thing. However, I think Japan is finally starting to get together a little bit more. They have really turned some things around, but I think it's still a turning around shift that's starting to work its way towards prosperity. We look at Asia, excluding Japan. We now see about a 4.6% growth rate. Okay, we get into advanced economies, not as much. But in emerging markets, this is one of my favorite areas right now. That's 4%, 4.1. So really interested in what's happening with emerging markets has got to do with our dollar. A weaker dollar is better for emerging markets, and the reason for that is they repay most money back in US dollars. So if they're cheaper, it makes it easier for them to pay back any of the loans that they may have. But overall, we'll talk about how that looks into where we're going to invest our money. As you might have guessed, I like emerging markets, right? Come on. Good. So stock. How's the tailwinds and AI? We talked a little bit about AI and what that means to us, right? AI, the data centers. So think about a data center right now. As I told you, they were building one. I don't know if they broke ground for one year yet. I know they've been fenced off. It's fenced off and looking. It's quite a process to watch. You'll have to drive by it every so often just to see the front of the state goes. Yeah, it is huge. So the one in Bowling Green, I forget, it's really not Bowling Green, it's in between Bowling Green and Perrysburg. To me, it's huge. It's quarter the size of the one they're building in Atlanta. So, some of them are just huge, like 3 and 4 football stadiums, huge, okay? That's how big. So there is approximately 1,800 people working at that data center right now, building it, putting it together, doing all the things that need to be done. How many people do you think are going to work there in 2 years when it's built? Between 100 to 150. That's it. So, okay, big difference. So we talk about AI and losing jobs. That might be some of the way, but not necessarily because AI took their job. So why do we believe the market's going to be good? We'll give you the good and the bad on why we think the market's going to be good. We are in the 4th year of the bull market. So what this slide is showing you is from all the way back to 1949, all the way to now. What is the average return that you're going to receive in a bull market in the fourth year of that bull market? They normally don't last that long. A lot of bull markets only last 2 or 3 years, so we're in year number 4. So we're in this current bull market right now. Okay, the blue line is the first year, the orange line is the second, the teal is the third, and then the darker blue teal, then pretty close in color there, is the fourth line. We do believe we're going to get about a 12 or 13% return this year. If we just look at this, there are some other factors though, that would tell us that for the S&P, that's what we're looking for. Okay? Here's the other one, okay? So last year, what happened with bond market? We're in a rate cut last year, right? And being the stock market really happy, okay? They like rate cuts. Cheaper money means more money is going to go in the market. You're not earning anything on your bonds, so where are you going to go? You're going to invest in the stock market in order to make a return. So that's why the stock market likes cheaper money. So if we look here, we want to know what was happening when that rate cut happened. So we're looking here, cuts with no recession, cuts with a recession, and all cuts in general. So the teal line, no recession, okay? Orange line, it's cuts with a recession, and then last but not least, all cuts in together. So you can look here. If there was a recession going on when they had the rate cut, we'd be negative for this year, okay? Because what's happening? Market's not doing so well. The economy's not doing well. More than likely, we're not getting the growth we're looking at. But we're getting a cut with no recession. The average is about 18.2% of return. I don't believe we're going to get there. Don't get that excited. But that is what's happening. And then if we look in general, it's about 13%. So we do believe that there's still some tailwind behind us to help keep this market going, and this is one reason. So if you ask me, and we'll talk a little bit, are we going to get any rate cuts this year? Yes. When? Not before June. That would be earliest we get one. We have the Federal Reserve Chairman right at the moment, right? That our dear president loves, right? He just thinks he's the best guy in the whole world. So I know you find that hard to believe. He has nominated somebody new who will not go into place until May, and that depends on Congress. As of right now, they are not even interested in talking about approving him. So, and the boys decide they want to play, maybe we'll get a Fed chairman put together. But he then still has a committee, right? That committee then has to agree with whether or not we should raise or lower. I don't believe he's going to give you one. He's more of what we call a fiscal hawk. He does not like inflation. I don't believe that you're going to see him just roll over and say debt and give everybody an interest rate cut. So a couple things that have driven the market in the last few years, right, are just certain stocks. Now we're starting to see a broadening of that, but let's talk about this one here. Okay, these are hyperscalers, okay? So that's a different term for us. The hyperscalers are Amazon, Microsoft, Google, Meta, and Oracle. Since 2003 to 2027, their annual growth rate is 40%. So if you own just those stocks, you will really have. You might not like the ride. You might have called me a couple of times along the way and said, what were you thinking? But if you just left them along, you had a nice price, okay? We believe that will continue. As you look here, the estimate is continuing to grow into this year. Those big companies are where it's at. They can buy all the small AI guys. That's going to be for me. That's all the money is going to be made. But we don't want to leave out our friends here, the Bag 7, right? We talked about Magnificent 7 now for, I think, 3-4 years. Okay, Magnificent 7 is going to be some of the same stocks, other than Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. How many of you believe Tesla is a car company? Yay, no one's raised their hand. It is not. It is a technology company. Through and through. Always probably has been. They just happen to produce cars as well. Okay? We do believe Mag 7 is still going to continue to grow higher, form the origins like the S&P is, but just at the rate that we saw back in 2024. So the blue line here is Magnificent 7, orange line is S&P 500 growth stock. Still believe they're very important. They're going to be in all your portfolios. You may not see them as the individual stocks, but they are in all of the mutual funds that are out there. So we are going to see those continuing to go. So I told you we have to talk about cultures a bit, right? Midterms. So what do we know about midterms? Midterms tend to make a few things different, right? In a midterm, one is the one thing that normally happens. Whoever's in power in the White House normally does not control either the Senate or Congress. They normally lose a few seats there. And I don't mean just a few. On average, they lose 23 seats in the House. That's the average. Do I think that's going to happen? I just don't know anymore, okay? I think it's too hard to read, and I think it's way too early to make that decision, right? So, but what this is showing you here during presidential cycles, and this is going to be in that first year goes all the way back to 1950 during the. And what we're talking about here is more about the volatility that's going to return yet. So, average return first year in office is the blue. The orange is the drawdown. That's the drawdown means nothing more than what the average downside was during that time frame. And then we have the realized volatility. Okay? Election year. See where the volatility is up there? Way up. So the volatility we measure in something called the VIX. The VIX index, I did not look at it today, but it's been in the low 20s. Last year, it was probably averaged about 17 or 18. At the high, it goes to the 70s. That number will continue to go. That VIX index is going to be all over the board on any given day. It can start at 20, go to 40, end up back at 20 again. It's just kind of depends on what's happening. Do we have anything political going on around the world right now? Right? Are we moving another ship to the Middle East? Yeah, it's not. Okay. So we have lots of things that's happening, and we'll have to keep that in mind. With that all said, we're going to talk about bonds, and then really interestingly, at least the bonds are going to be they're here, okay? We're going to continue to get our return out of them, not much. You know, they're going to give us our 4% return, nothing special. To me, that's special because when we do for 10 years, even simple, interest rates were nothing. This right here is a little busy, but all it's telling you is the 10-year treasury is correlated to the Fed fund rates trough to peak. So what we mean by that is when interest rates are the lowest to when interest rates are the highest. So we see the line down flowing, which basically is just telling us that we have a range that we believe that the 10-year treasury is going to be at. We believe that the 10-year treasury is going to be LPL will be somewhere between 3 3/4 to 4.5. I believe it's going to be somewhere between 4 and 4.25. LA is going not even going to be that much more about that. We might get a day or two in now. Just don't see it. You know, I don't see any catalyst to make it change that much. If we get one rate cut, I think that's probably a running bot to them. So here's another interesting topic. As we debate this, we meet once a week and have a meeting just to talk about the market and what we believe is going to happen. Now, the bond market is one of our favorite things to talk about because, like I said, Wall Street hasn't got it right in I don't know how many years. So we try and work our way through. So what this slide is showing you is rates, okay, and adjusted for what's going on around the world. So we have investment grade, high yield, triple B, double B, single B, triple C, and bank loans. Where we are right now is where's the spread? So there is zero risk in a treasury, right? The federal government probably is some risk, but we call it a zero risk, right? Because we've never defaulted on our own. So if I want to make more than what the Treasury is willing to pay me, let's say I'm buying a 10-year and I want to make more than 4, I'm going into one of these other vehicles to it. I'm going either into corporate bonds, I'm going to go to high yield bonds, I'm going to go to something less than high yield, or I'm going to go to bank loans, trying to get some bang for my buck, okay, as I'm going up. What this slide is telling you with this below the turquoise line is that I'm not getting enough bang for my buck to go out and take risk. So I'm really not getting enough extra to go out there and say, if I go to high yield, okay, and I can get 5 in high yield, how much more risk did I have to take to get that extra 1%? The risk is a lot more, okay? And so, but there's another reason we look at bonds, right? And this happened last year. So the bond market really, we didn't talk about it all last year. But if you own bonds last year, you actually made more than a coupon because they got a rate cut. So bonds have an inverse relationship, right? If these interest rates go down, your bond fund went out. If interest rates go up, your bond fund goes down. And that's really what this slide is showing you right here. So if we look at the Jace case right here, interest rates is nothing. The average bond right now on average bond market is about 4.3. Right? That's what you're going to get. However, if the Federal Reserve lowers rates and we get a capital rate change and you own that same bond, your rate just now went up to 7.1. Not because you got more in a coupon and lower interest, because the bond is more valuable. Because you got it better than I did somebody else. And if we get one, that goes all the way up to 9.9. You can see what happens on the other side in a fair face, okay? Nothing happens. You get a rate cut, a rate go up, rate goes up by 0.5%. You're now 1.6 on that 4% bond. So, nice chart just showing you what happens when rates change, okay? And where do we want it? Kind of why we just use a little bit of everything there, just trying to make sure that we're taken care of and we get some kind of return on our bonds. So alternative investments, it's a hard one to talk about. Mergers and acquisitions, which basically is just companies going up and buying other companies. That happens a lot. We believe that activity is getting better. When rates go down or stay the same, a lot of those happen because they can borrow the money to buy the other company. They can do it in shares. There's lots of things that happen there. So when you see the blue line here, this is from 2019 to 2025. This is the global mergers and acquisition deals, okay? And then the average value of those deals. What happened? The average value has been very good. What's the big one that's going on right now, right? Okay, Netflix and Warner Bros., right? I think they've been talking about it now I don't know, months, months upon months. So maybe one day they'll get it done, but there's been lots of them that go on every day that we don't care. They're smaller companies. So there's actually mutual funds that's all they do is buy companies they think are going to be buying and sold. And we buy them as an alternative because generally they give you somewhere around 4.5-5% in income on those funds. So it's a way for us to put something else in a portfolio that will give you a return that's not correlated to the stock market or the bond. So we talked a little bit before about currencies and dominance. This one here has to do with our dollar. And yes, the dollar has come down. I did not look at it to see what it was trading today, but it's been trading around 76, 77. Seems to stabilize right there. We do not see where our dollar is going to lose support. We do not see where our dollar is going to be replaced anytime soon as the world's economic powerhouse. I'm not looking for the Chinese yuan or any other currency to be the one in charge. Now, are lots of countries buying other things? Yes, but our dollar is still the powerhouse that it's at. So commodities, there's nothing happening in the commodity market, right? How many of you got the gold commercial coming every day? Your cash out your 401k and buy gold. Okay. That has to do with, number one, inflation. Anytime there's inflation, eventually it goes into the gold market. But it also has to do with what's happening to our dollar. So other countries are also buying gold. The United States holds the largest gold in the world. Okay, we have the biggest amount of reserve in the world. It's already been mined and put somewhere. Not necessarily it's in the ground, but it's actually in a vault somewhere. So we're seeing other countries start to do that as well. Just because they want to hedge their bet too. If the dollar keeps going down, they're going to hedge themselves. So we're seeing a lot of other countries buy gold. And then just the general public, the fear of missing out, right? We call it FOMO, fear of missing out. Everybody jumps in. And unfortunately, when do we jump in? When it's about to pop.
Yeah.
So for years, he always left gold in the portfolio. But God, I don't know how many years it just do nothing. It just sat there and did excellent though. So we have not put it in our portfolio as often as we used to. There is some in it. It's in almost all the mutual funds. Some portion of it is there, one way or another, whether it's a mining company or whether it is actually the mineral. It's not something that we're out there just actively going up and buying. It's not just gold, silver. Silver is in all this technology, okay? Platinum, palladium, all those kind of things go into everything's going on with our technology. So we need some minerals, yes. Do we necessarily just need gold? The answer is no. So this slide here, this is kind of telling you when this was written. Okay, this was written last November. That's where the gold did the set is right now. So if you're looking here, this is the commodity index, it's the blue line. and the 40-day median average is the orange line. It worked on through the end of last year. So we did see a big spike up, but we saw a huge jump, a year ago, 10 days ago now, especially in the silver market. Silver market just got crushed. It went from 110 to 70 in like 3 days. So crushed. And now the bull market is most of it is rebound on the bull market. So here, this is another reason why we're staying showing bull. If there been anything happen in the world, okay, this is showing Russia invades Ukraine, Hamas attacked Israel, and the tariffs. So if any of you remember last April, and probably didn't like this very much last April because what happened to your portfolio, it just went, Trump announced he was going to do tariffs, and we thought the world was coming to an end if you would have listened to all the pundits on television. Okay, now that didn't come to pass. Some of it caused some trading volatility. It's caused an uproar with the Supreme Court. You name it, it's caused issues, but it did not make our economy collapse like what people thought was going to. So, but a lot of other countries were worried because they listened to all the pundits too, and so they started buying gold because of all these other things that were happening. And we can see that in this slide. So central demand is the turquoise. So we can see where central demand from 2020, how it's getting bigger in 2022 and 2023. And then again, this last year got bigger again. ETF is what I'm talking about. That's an exchange traded mutual fund. That's the orange bar. So because people are interested in it and a way to make it liquid, to your point, okay, we can actually go in and buy it that way and exchange traded fund. We're seeing that we're getting more, especially in the fourth quarter, more people interested in adding that to their portfolio. That's a way for us to do that.